For decades, China stood as the unrivaled titan of global manufacturing, luring trillions of dollars in investments from regions as diverse as the United States, Europe, and East Asia. Its allure was undeniable, a potent blend of low labor costs, minimal regulatory barriers, and a vast workforce eager to fuel the engines of industry. This seismic shift in manufacturing landscapes translated into unprecedented profit margins for businesses, notwithstanding the logistical complexities and expenses associated with trans-Pacific shipping. However, as China's economic dominance burgeoned over the past decade, so too did a litany of challenges. Wages soared, fueled by an increasingly affluent middle class demanding higher standards of living. Concurrently, fuel and transportation costs skyrocketed, further eroding the once formidable cost advantage enjoyed by Chinese manufacturers. Currency fluctuations became a recurrent headache, injecting volatility into already razor-thin profit margins. And as China's political influence expanded, so did concerns about the reliability and stability of doing business within its borders. Yet, the story did not end there. The turning point marking Mexico's rise in international trade traces back to the tumultuous events of 2018. Amid tensions, the Trump administration initiated tariffs on Chinese imports, citing intellectual property theft allegations. This sparked a full-fledged trade war, with China retaliating and igniting a tit-for-tat exchange felt globally. Amidst escalating tariffs and geopolitical tensions, the world grappled with the COVID-19 pandemic. Lockdowns and supply chain disruptions altered consumer spending patterns, driving a surge in demand for physical goods. However, supply chain issues persisted, from congested ports in Los Angeles to manufacturing hubs in China, South Korea, and India. Geopolitical turmoil further disrupted global trade, notably with Russia's invasion of Ukraine impacting established trade routes. In this tumultuous landscape, Mexico emerged as a stable and lucrative option for U.S. companies seeking refuge from the chaos. Enter Mexico, a country teeming with opportunities. Competitive wages, a stable workforce, and efficient shipping routes all made Mexico an attractive alternative. So, as China's star dimmed, Mexico's was on the rise. But how did this happen? Well, let's start with wages. Mexico boasts competitive wages and labor costs that are increasingly attractive to companies seeking affordability. The average monthly wage for manufacturing employee in China in 2023 stood at approximately $2,790, whereas in Mexico it hovered around $1,317. This substantial cost differential, coupled with Mexico's proximity to the lucrative U.S. market, made it an irresistible proposition for companies seeking to maximize their bottom line. Next, the country presents demographic stability with a young and dynamic workforce that's ready to meet the demands of modern industries. This is in stark contrast to China, where the manufacturing workforce and overall population are on a downward trajectory. Mexico's population is projected to steadily increase from its current 129 million to over 155 million by 2060. Furthermore, Mexico boasted a considerably lower median age than China, with demographic trends favoring continued growth and vitality. But it's not just about the workforce. Mexico's efficient shipping routes and robust transportation infrastructure make it a logistical dream for businesses. The country's geographical proximity to the United States also adds to its appeal, reducing shipping times and costs. And let's not forget the transparent regulatory framework. Mexico's political stability and clear regulations provide a conducive environment for businesses to thrive. Finally, Mexico's economy is on the rise. With steady economic growth and a burgeoning economy, the country presents a promising future for manufacturing. Mexico's burgeoning economy has surged from a GDP of $1.4 trillion in 2022 to over $1.8 trillion in 2023, underscoring its credentials as a burgeoning economic powerhouse. Trade volumes and investment trends attest to Mexico's economic ascendancy. A clear sign of Mexico's rise is the substantial increase in U.S.-Mexico trade volumes. Over the past decade, these volumes have grown exponentially, surpassing those of the U.S. and China. In 2023, the United States trade volume with Mexico amounted to $798.83 billion, while the total value of the U.S. trade in goods with China amounted to around $575 billion, composed of a $147.8 billion export value and a $427.2 billion import value. This represented a negative trade balance of $279.4 billion. Investment trends, too, paint a vivid picture of Mexico's ascent. Foreign direct investment in the country has seen a consistent upward trajectory, with a significant portion coming from the United States. From January to September 2023, the foreign direct investment from United States to Mexico amounted to $13.5 billion. This is a strong indication of investor confidence in the country's economic fundamentals. Moreover, some of America's most prominent corporations are setting up shop in Mexico. For instance, Tesla unveiled plans to construct a sprawling factory in the northern border state of Nuevo León, with an estimated investment exceeding $5 billion. A proof that the nearshoring trend is taking off as companies seek to move production away from Asia and set up operations closer to the United States. From automotive giants to tech behemoths, these companies are drawn to Mexico's competitive wages, efficient shipping routes, and stable political environment. However, though promising, Mexico's rise is accompanied by certain challenges. Infrastructure, while improving, still has room for growth to meet the demands of a burgeoning economy. Investment in education, particularly vocational training, is essential to ensure a skilled workforce that can drive this economic growth. Moreover, the influx of Chinese investments in Mexico adds a layer of strategic complexity. These challenges notwithstanding, the shift in global trade dynamics is undeniable. The global trade dynamics are shifting, with Mexico at the heart of this change. The US-China trade war has rattled global markets, intensifying the search for stable alternatives. Amid these geopolitical tensions, Mexico has emerged as a beacon of stability. Its proximity to the United States, coupled with a robust manufacturing sector, has made it an attractive option. The strategic maneuvers and nearshoring trend further emphasize Mexico's appeal. The shared border, common language, and cultural similarities have all played a role in strengthening these ties and facilitating seamless business operations. In addition, Mexico's commitment to transparent governance and ethical manufacturing practices makes it an attractive destination for businesses seeking a stable, reliable partner. While Mexico's ascent may not challenge China's global supremacy directly, it represents a significant shift in the global economic landscape. The burgeoning partnership between Mexico and the US, forged amidst trade wars and geopolitical turmoil, signals a new era of economic interdependence and shared prosperity. This partnership has the potential to further deepen, offering stability and growth opportunities amid uncertain global conditions. That's where we end our video. See you in the next one. Thanks for watching.